definitely say that most consumers think that if they get the lowest interest rate, it automatically means they're going to make the lowest monthly payment. And if that was the only thing to consider when getting a home loan, that logic would be gold. But the truth is, getting a mortgage is more complicated than that. And we're in an environment where interest rates are high and they're also volatile. And as somebody who has worked in mortgages for 21 years, I will tell you that it is really difficult for me to even make an educated guess as to where interest rates will be in the next 6 weeks, let alone 6 months. I can tell you that in the long-term trajectory, interest rates will go down. But right now, interest rate can't be the only thing that you have to consider when shopping for your home loan. And I know that I talk to a lot of home buyers and they feel constricted in their budgets. They're discouraged by their buying power. And I wanted to talk about all of the different strategies that you can employ when trying to save money on a monthly basis and just trying to extend your overall buying power. So the number one thing to consider outside of an interest rate has to do with the way your loan is structured. And if you're a first-time home buyer who isn't qualifying for a USDA loan or a VA loan, chances are you're going to be qualifying for a low down payment program, anywhere between 3 and 5% on either FHA or conventional financing. And it is super important that you ask your loan officer for a loan comparison for both products for similar down payments. And the reason for that is because most loan officers will literally quote you whatever you call in for. So if you're only familiar with an FHA loan, they're only going to quote you that. If you're only calling in about a conventional loan, quote you on that. And chances are you're going to be asking for whatever your real estate agent told you to ask for. It is really important that you ask for both scenarios because they vary pretty significantly due to credit, property type, the number of borrowers, and debt to income ratio. Depending on your financial scenario, the payment differences can be anywhere between, $100 to $300 a month. And so I think it's super important to get 2 different quotes. I will also say anecdotally, based on my own client experiences, I have noticed that FHA, due to the recent changes, and I'll link a video on that below, has been giving me lower monthly payments because the interest rates are slightly better and the mortgage insurance is much improved when people have, moderate to lower credit. And so definitely want to look at that. Also know that you want to get quoted specific for the property that you are buying when you are under contract, and make sure that that is still valid when you're under contract, because things like property type can also really impact a mortgage interest rate quote. So I'm talking about things like sometimes I'll qualify somebody for a single family home and then they'll come in with a manufactured contract or a townhome or condo contract, and that will definitely change pricing. So loan structure and getting a loan comparison, it's the number one thing to do to maximize your buying budget and to get the lowest monthly payment. So the next thing to consider on your home loan structure has to do with mortgage insurance. And most people know that they don't want to pay it, but unless you're putting 20% down, you will. And it's not always permanent. If you're on a conventional loan, just know that when the property reaches 25% equity and you've paid it for 2 years, you can request that the mortgage insurance company drop the mortgage insurance with an appraisal. And on an FHA loan, you'll just have to refinance. In this market, because interest rates are so high, most people will be refinancing in the future. And so most people will have, at least 20% equity within 3 to 5 years. So I wouldn't make that like the determining factor of whether or not you purchase. It's just something to consider. But there are ways to lower what you pay on a monthly basis. And so the more you put down, generally speaking, the lower the mortgage insurance. Again, it also varies based on loan type, property type. Your loan officer can shop mortgage insurance, just so that you know. I would also have them get multiple quotes for mortgage insurance and then multiple structures for your mortgage insurance. So if you are getting a conventional loan, just know that there are 3 ways to structure that. You can do a upfront premium where you just buy out the mortgage insurance. You can do a split premium where some of it is included in the closing costs and some of it is paid for on a monthly basis. And then you can have a monthly payment. And there's a variety of different mortgage insurance companies that your loan officer should be shopping to make sure that they're getting you the lowest monthly payment. And so that is something else to ask them for. And again, unless you are asking for it, chances are they aren't just going to offer that information. So the next thing to consider when you're trying to improve your overall loan terms is your down payment. And down payments have a whole lot of misconceptions to them. Many home buyers think they need 20% down because, back in the olden days when getting a home loan, that was the only way to buy. And there's a very popular, budget expert that preaches 20% and a 15-year mortgage, and it confuses a lot of consumers. But you do not need a 20% down payment to buy a house. And in fact, I wouldn't die on that sword, because most people in 3 to 5 years will have enough equity in their properties to either remove their mortgage insurance with an appraisal, or they'll more than likely do a refinance because of high interest rates. But I will say this, if you can put down a larger down payment, you will improve your overall loan terms, especially if you're getting a conventional loan. Conventional loans really reward in mortgage insurance and in interest larger down payments. And there are some improvements on FHA loans. While they're not as dramatic, they will reduce the number of years that you're making in terms of mortgage insurance if you put a 10% down payment. And there is a slight improvement when you go from 3.5% to 5%. Let's say you are a qualified veteran. I also think it's important to note that if you put down a down payment, even though you don't have to, you will reduce your VA funding fee. And so there's lots of benefits when you put down a down payment, but also know that there is a diminishing return the larger the down payment, believe it or not. You will absolutely pay lesser interest because your loan amount is down, and you will have a lower monthly payment because of a lower loan amount. But there is opportunity cost when you're withdrawing from investments that have higher yield, and occasionally that money could be better served in different areas like paying off debt. Okay, so this leads me to my next point, because I'm seeing a ton of consumers have these large down payments because they have a house to sell with a big amount of equity, or they have large savings, but they're also coming to me with a pretty significant amount of debt. And sometimes it makes more sense for your overall financial picture to pay off or reduce the debt than it does to make a larger down payment. And that's because, depending on the amount that you're putting down, for every $1,000, it'll impact anywhere between $5 and $7 of your monthly payment. And I recently had a scenario where a client came to me and they were adamant about a $2,800 monthly mortgage payment because they had $300 in minimum reoccurring credit card debt. And when I let them know that $300 was the equivalent to $60,000 additional down payment or reduction in their buying power, it made way more sense just to pay off the $11,000 worth of credit card debt. And for a lot of consumers, guys, especially in 2023, when we're talking about a potential recession, we have to look at finances holistically, a complete financial picture. And so even though having a lower monthly mortgage payment might make us feel more stable because we know that that's the place that we're going to live, it doesn't always make the most sense for your full financial picture. All right, so for the final strategy, and I know I started this video out by saying let's not concentrate on interest rate, but you can buy down your interest rate as a strategy to bring down the monthly payment. Now, if you are going to do this as the consumer, it's going to be called a discount point, an origination point, or a permanent buy down. And it isn't a dollar for dollar equivalent. And a lot of people think it's a percentage to percentage equivalent. So like if you pay 1% of your loan amount, it's going to bring down the interest for 1%. That's not how it works. Every interest rate comes with a credit, a cost, or it's at par, meaning it's even. So no cost, no credit. It's a fraction of a percent for a percentage of your loan amount. And so you will want to get quoted for this. One thing to note is that there is a high likelihood that you will refinance this loan. And so your loan officer better be providing you with a break-even cost on when you will stop seeing an ROI on this, right? So the upfront costs in terms of monthly savings, there is a number of months you will have to keep that loan for so that it makes sense, right? And chances are you will be able to refinance between 18 to 24 months. So that's just my caveat on that. Now, if you're getting the seller to contribute to your closing costs, they can most certainly pay for the discount point, but there is something called a temporary buy down. And this is where the seller will put in escrow money to subsidize payments for 1 to 3 years at a lower interest rate. And this is a wonderful strategy that a lot of sellers are employing to sell their houses at top dollar. And it's something that you should ask your real estate agent about and talk to your loan officer about, because it will have to be negotiated and paid for, not by you. This is an awesome way to save some significant amount of money, at least in the short run, because we believe that refinances are on the horizon. Guys, this concludes my top 5 strategies for how to reduce your monthly payment and maximize your buying budget. But if there was a question or there was information that you wanted to know, just go ahead and leave me a comment below and I would be happy to answer them, guys. And if you found this information helpful, don't forget to like, comment, and subscribe to the channel.